Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everybody, to this Peak Prosperity Podcast. I am your host, Chris Martenson, and it is, well, let's see what day it is here. It's September 18th, 2018. Well, listen, today, we're going to be talking about financial markets, equity markets, bond markets, commodity markets. Today, listen, they all share one thing in common. They are utterly deformed, quite possibly irretrievably so. And if you've been listening to me for a while, you know I don't just refer to them as markets without putting not one but two sets of quote marks around them now. Markets, double air quotes. Things started to go off the rails some time ago, back when computer algorithmic trading took over and so badly outpaced regulatory efforts to A, understand them, or B, regulate them, that there was really never any sort of a contest. So here we are. And combine that regulatory lack with the fact that the existing power structure, big bankers, central banks, they had really had aligned interests in seeing the markets become more stable. They wanted to see them head higher. So I don't think there was ever any realistic pressure to prevent our markets from becoming the way they are, maybe quite the opposite. So discussing these markets with us today is a man we first interviewed on this subject back in 2011. That was before the book Flash Boys came out. That's by Michael Lewis. Great book. And then again in 2015. We're talking today with Joe Saluzzi. Joe Saluzzi is partner, co-founder, and co-head of equity trading at Themis Trading LLC, a leading independent agency brokerage firm that trades equities for institutional money managers and hedge funds. So obviously he's got a lot of interest in how those trades go off and, of course, even more experience around that. Joe is one of the most foremost experts on algorithmic trading, often referred to as high-frequency trading, and the dangerous risks that those trading practices have introduced in our financial markets. He was very recently just testifying before Congress on the Subcommittee on Capital Markets, Securities, and Investment. That was back in June of 2017. And this was in a hearing entitled U.S. Equity Market Structure, Part 1, Review of Today's Equity Market Structure and How We Got Here. I think you need to know how we got here as well so that you can understand where we might be headed. So along with Sal Arnunk, he is the author of Broken Markets, How High-Frequency Trading and Predatory Practices on Wall Street Are Destroying Investor Confidence and Your Portfolio. Welcome back, Joe. It's really great to have you back with us today.
Thanks, Chris. It's been a while, and I'm glad to be back on. Thanks.
Well, Joe, after our previous podcast, I came away a little bit more convinced than ever, and I didn't need a lot of convincing that maybe our markets were broken. But that was 3 years ago. Is it wrong for me to still think they remain largely unfixed, maybe rigged, if not broken?
Conflicted is a good word that we can certainly still use.
Okay.
Yeah, there are lots of conflicts out there, and we tend to gravitate back towards the exchange model and how the stock exchanges changed over the years as a source of many of those conflicts. But it's interesting how the high frequency traders that we've talked about for many years, they're starting to, I wouldn't say go away, but compete with themselves to the point where they're pricing each other out, certainly in the equity market, where the margins, I believe, got so small and their cost continues to rise because they need to constantly compete with each other. And remember, an important point is high-frequency traders don't compete with you, the investor, because you're always the loser. They're competing with themselves to be the winner to get to the loser. Right? That's their game. They know they always win. It's just a matter of which one's going to win. So they have to get faster and faster and faster and continue to have more technology and better processing and better strategies. But it got to the point in the equities market, there's really not much left for them to squeeze out. So as always in other markets, they'll find other markets, they'll find other pastures. And years ago, we wrote a post about, we call them locusts, basically, and how they're going to strip the farm, and once they're done cleaning out this farm, they're going to move on to another. And that's kind of the path we see. We see them still around. They're still out there. They're still causing, they're still doing their thing. You still see these mini flash crashes throughout the day where stocks move 10% for no apparent reason and then just shoot right back up. That still goes on, but some of the issues that we saw way back are, I don't think, as prevalent. I don't want to say that, but again, going back to the issue, the market's still conflicted, and that's really more from the brokers, from the institutions, from the exchanges. We still got a lot of issues. That's what I testified to Congress about structural issues that we need to address. But HFT hasn't gone away, I guess is the point.
Well, let's talk about that for a second, just to set the stage. How much of the daily trading volume in equities in the U.S. is done by these HFT machines?
There hasn't been an estimate lately. I mean, the numbers that are still north of 50% are certainly probably accurate. You know, the definition of high-frequency trading is something that's been debated for years. I actually sat on the CFTC subcommittee, and one of our tasks was to define HFT, and we really couldn't come to an agreement of what is it. Right? Is it low-latency trading done by computers without the intervention of a human? Sure. Is it proprietary trading? Yes. Do they hold inventory? No. Overnight. So there's all sorts of things where certain parts of the industry didn't want to be labeled HFT because then they were afraid that the regulators would come in and regulate them as HFT. So the number is kind of a tough number to come up with to answer your question because people don't know exactly what it is. In other words, if you're a firm and you're participating in this type of activity, you don't label yourself as a high-frequency trading firm. You label yourself as a hedge fund trading for a proprietary account. Well, what does that mean? It means, you're trading on your own behalf, and somebody may say, well, you're an HFT firm, and they'll say, no, I don't know what you're talking about. I just trade, I trade in and out of positions in a low-latency way, and I use it as an automated basis. So they're getting cute, they do what they do. But they are where they are. Again, I think it's more of a structural issue. We wrote the book Broken Markets because we think the market itself, the underlying structure, helped create high-frequency trading, namely Reg NMS, which was a regulation back in 2007 that the SEC passed. That helped create a ground which was very fertile for HFT to come in and take advantage of all sorts of easy arbitrage opportunities between one market versus another. And like I said before, they tend to have closed that gap, and the arbitrage opportunities aren't there, which is why, by the way, if you notice that some of the biggest HFT firms and players are now moving over to the crypto space, because that's a much more fertile ground, which will much less regulation, which is much easier for them to jump in and out of.
I can't wait to get to that topic, and we will, because I've had that. I can't wait to get your insights on that. But let's set this up a little bit further before we get there. So you mentioned earlier that this is becoming a more of a competitive space, and you also mentioned that you, the little guy, loses. So first, distinguish for us between investors and traders. I assume when you said the little guy always loses, you meant anybody who's trying to trade against these machines by definition has to be losing because, and correct me if I'm wrong, but the last time I was aware of the data, there were some of these firms that were reporting in their quarterly and yearly earnings that they weren't taking any losses at all. They were just money-making machines. Is that still true? And how does that differentiate for us between investors and traders?
They were back then. There was actually one firm, and it's a public company now, Virtu, but they've merged with another company, Knight, and it's kind of changed and morphed their business model. But when they were pure HFT, they were not shy about the fact that I think it was one day that they reported a trading loss. But what's interesting about that number is the way the HFT firms work are they don't count every trade. In other words, at the end of the day, they made 100 trades. They may have won 52 and lost on 48, but they're very smart on managing their risks. So maybe those 48 losers only lost, X%, and the 52 winners made more than that. So net on the day, they made money, which is why that statement that we make money every day is a little bit deceiving in the sense that, yeah, they're making money every day, but they are losing money on trades. But they are very good, and I'll give them this, they're very good in general. HFT is very good at risk management. They know when there's a bad position. They know how to cap that risk. They know when to sell when something goes wrong. And it's all automated, basically. So when you're automated, it takes the human emotion out of it, which unfortunately for us human traders and human retail folks, that's not there, and HFT thrives on that, right? Where if you're emotional and you're going to go chase a stock, well, guess who's going to be out there, selling it to you at a higher level? And the way they work usually is, since their latency is much better and much faster, they can get to a position or get to a quote quicker than you, they'll always be on top of the queue. Their orders will always be best on top of the book, where if you want to post a bid and you don't want to cross the spread, say, and you're trying to buy stock a little cheaper, you're never going to win until the HFT guy gets his, because he's out there first. And by the time you get your fill, most likely the stock's going to roll over, and you're going to say, okay, I bought it at 10 cents, it's now trading at 8 cents. Well, that stinks, because probably an HFT guy sold it to you. But that's the game they play, which is why I say you'll never win that game. So you play a different game as an investor. You can't be a day trader. If you're a day trader and you're trying to compete with the machine, it's a losing game. You'll never win. As an investor, you can potentially win. Maybe your positions are, a couple of days, or a month, or whatever it may be. But if you're trying to flip in and out of a stock, within a minute, thinking that you're going to earn a dime or something, you're going to get hurt. And it's just the machines are that good, and that's what they do for a living, and that's why they spend billions of dollars on an industry like this. So tough for the little guy there, but and what we always say, and we trade for institutional accounts, so we don't trade. One important part of our business model is we don't trade on behalf of our own account. In other words, I never have a position. I don't have any proprietary money in this game. I'm trading for my clients, so we're agency only. And our game is not to compete, as our institutional investors who are our clients are long-term mutual funds, pension funds, and so on, and they're not competing with HFT on a minute-to-minute basis. So, in other words, we're not playing their game. I don't need to chase them all day long and run around, like all over the street with them. I'm going to play my own game and pretty much try to, play with them and see if they can go into my trap. It's trading, right? This is what we do. I'm trying to get a better price for my client. They're trying to get a better price for their proprietary account. We'll see who wins at the end of the day.
Now, here's something I've seems obvious to me at the surface. I've never quite understood that if you do have a company like formerly Virtu or Citadel or one of these other ones who are reporting like just these massive gains, or even the prop desks for some of the big banks, JP Morgan proudly saying, we only had 2 days of losses in the last year, or zero, or whatever the numbers are. To me, those billions that they're pulling out had to come from somewhere. Where did those come from?
Sure. I mean, they're earning profits. They will say that they're taking risk, and this is the biggest thing when you talk to an HFT or anybody at a brokerage or a bank. We're earning money by taking risk. We're putting our capital at stake, and therefore we deserve to earn a return. And to an extent, I agree with that. If you're a market maker, a legitimate market maker who's supplying bids and offers throughout the day with a decent-sized quote, you're trying to earn the spread. You're trying to earn the difference between the bid and the offer, and you're taking your capital and putting it at risk at that point. Well, then you deserve to earn something because you're supplying liquidity to the market and you're adding to the capital base, right? But if you're not really a legitimate market maker, which I would argue many of these HFT players are not, they're more proprietary traders who trade on one side and trade only when they feel like trading. In other words, they're not supplying bids and offers all day long through a two-sided quote. They're coming and going as they please. Well, that's not supplying liquidity, that's taking liquidity. So not only are they taking money out of the market for their own, they're taking liquidity, which is a double bang for you, right? I'm not getting anything out of that. So that's why we take issue with many of these proprietary style HFTs where some of the more, if you want to call it, benign market makers, if they have legitimate obligations and legitimate quotes, could add benefit to the market.
Joe, this brings up a really important point, and I just want to take a half step back, and this helps set up my next question, too. I'm wondering if you can help all of our listeners understand the difference between volume and liquidity. These often get confused. We use the word. So can you separate them and help us understand what you mean when you say liquidity?
Sure. Liquidity is, at this moment, if I want to enter or exit a position, what can I get? In other words, what not only is the displayed quote or what's available for me to buy, let's say you're a buyer, how much is available, not only displayed, but on ETSs or on alternative trading systems or various off-exchange venues. What can you capture at this moment? How much liquidity is out there? And not only from a point to point, but throughout the day. I may say, a client may come to me and say, hey, I need to buy 100,000 shares of XYZ. The stock doesn't look very liquid is something that we might hear often, or the stock is extremely liquid. So if it's extremely liquid, maybe it trades 10 million shares a day, but that's the volume, right? That's what you were saying before, versus the liquidity, meaning the quote is thick. There's lots of bids and offers. It doesn't tend to move. The spread is fairly tight. I can enter and exit a position fairly easily without moving the name. So something like Ford, the letter F for Ford is an extremely liquid stock. There's tons of volume out there. You could pretty much buy a shell 10,000 shares at a clip anytime you want. That's liquid. However, you can take a stock that trades maybe 1 million shares a day, which might seem like a lot of volume, but it could be a very illiquid stock because the quote is maybe 12 cents wide and there's 100 shares bid for, 100 shares offered, and then you go out and try to say, okay, perfect example. Stock is 10 cents, 20 cents, 10 cent bid offered at 20, and I go in and I place a 12 cent bid because I'm trying to tighten the spread. Next thing I know, I got some joker who's out there placing a 13 cent bid. He jumped me. And then another guy goes 15 cent bid. Now the 20 offer disappears. It's offered at 25. The stock's 15.25 and nothing's traded. It's all of a sudden, because I placed a bid trying to tighten the spread, the stock went up a dime and nothing traded. That's not a liquid stock, right? That's where the HFT guys love. They love to play that game to see that if you, the retail investor, posted that bid, now you're going to get frustrated. You go, oh, man, the stock's up 10 cents. Maybe something's going on. I should just take the offer at 25. When, in fact, you buy it at 25, and then all of a sudden it drops right back down to 18. You're like, boy, that was dumb. But those are the games that go on throughout the day. So when I look at volume, it is important, but it's not as important as liquidity, what I can and cannot get into the stock at a particular time.
All right, so let me see if this is a workable metaphor, because I know people struggle with this. I've just been trying to think of a way to explain this, and maybe this won't work. Let me know. But I'm thinking of a river right now. And so if we have a river that's only a foot deep, the depth would be its liquidity, but it could be pretty wide. It could be moving a pretty decent volume across. But if I tried to dive into this river, this might be a very unpleasant experience for me. Whereas if we had a deeper river, if it had more liquidity, like you could put more of a dive in, you could put a bigger bid in on that thing before you would risk sort of hitting the bottom of that particular piece. So is this sort of like can I use that, width versus depth?
Yeah, I think you can. I
Okay.
think that's good because, and we actually use the term depth of liquidity all the time, or depth of the quotes. In other words, what a lot of retail investors will see is the top of the quote. In other words, the bid is 10 cents, it's offered at 12, but that's a consolidation of all the different quotes out there, and it doesn't include off-exchange quotes. What I'm looking at is, so in other words, that's the top of the river, that's the top of the water. I need to know what's underneath that river, right? How far deep does it go? And so I'm looking at level 2 quotes, which are more quotes out there, all the various exchanges. I'm looking at time and sale quotes, trades throughout the day. I'm looking for volume and so on. I'm looking for all sorts of things that would tell me how deep is that water. I don't have a yardstick, right? I can't necessarily see how deep it is, but I can kind of judge it. And so I think that's a great analogy, actually.
Okay, well, thanks. So, Joe, this sets up this question. And I'm looking now at an academic research paper, came out in May of 2017. It's by Michael Goldstein of Babson College and the University of Sydney's Amy Kwan and Richard Phillip, which came to this conclusion, and I quote, "Examining the order book imbalance immediately before each order submission, cancellation, and trade, we show high-frequency traders supply liquidity on the thick side of the order book and demand liquidity from the thin side." End quote. Please translate that as for non-market mortals.
Right. So that's basically an example of a stock that's about to move.
Yeah.
So you'll see the quotes, and sometimes it doesn't always the case. Sometimes it may reverse, but you'll see a real thick bid. So the thick bid may be this 50,000 shares bid for on various venues, 10 different venues totaling 50,000, and there's only a couple hundred shares on the offering. So that tells me the bids are heavy. Most likely this stock should be going up. They'll probably take out the offer soon, and it'll tick up a little bit from there. So he's saying what's going to happen is that the HFT guy will be part of the bid because he has a very low risk of adverse selection, shall we say, but he's most likely trying to take that offer out too. And he's going to go out and grab and take that liquidity, which is probably be either by a retail investor or an institutional investor not really paying attention to the book size or paying attention to the book liquidity that Professor Goldstein said, and then the stock's going to go up. So they will be demanders of liquidity often, and at times when it's usually adverse to the regular investor. Again, that's why they build, that's why the HFT guy can spend billions of dollars on co-location facilities at the exchanges or buying proprietary market data from the exchanges, because they need all that information to make those trades, to make money, to offset those costs. So it makes sense. Professor Goldstein's right on.
Okay, so then this gets me to this idea of flash crashes, because what I'm trying to build here is so that people can understand what's really going on out there. And so as I understand it, and again, please correct me if I've got any of this wrong, that what might happen is we see all these apparent orders that are sitting out there. Like you look at the bid and the ask, and there's a bunch of orders on each side of it, but then something happens. And so we're looking at this, we're saying, wow, this pool is 7 feet deep, I'm going to dive in. But the minute you start to take your dive, you find out 5 feet of that water was just a mirage. It just evaporates. I'm thinking now of the times when Eric Hunsader out of Nanex is showing, these moments where liquidity just evaporates, just literally sometimes in milliseconds. But, normally it's just a couple of seconds, and all of a sudden you discover the pool is not deep. It's very, very thin. Is that what's being talked about here?
I believe so. And what we'll refer to those quotes often, and other people as phantom quotes. So there may be 10 quotes out there for 1,000 shares, but in fact there's really only one. The other ones are pinging off of that. So if it's all of a sudden, and those are the faster ones who are doing the pinging. So if an HFT guy is one of those guys pinging off the other quotes, trying to get a free ride essentially off the one real quote, and they sense that something's going on, maybe they see a trade occur at an exchange, and they have a faster line they have lower latency to that exchange, so they can see the print before it hits the general tape, which is called the SIP, And this used to be a much greater by the way, the difference between the two used to be much greater, which is why it was easier for the HFT guys to make money. Since over the last few years, they've tightened that up dramatically. So the public feed is actually very close now to the proprietary data feeds, time-wise. But let's just say that HFT guy can see that. What they'll normally do is as soon as they see something going wrong, they will cancel all their bids because they don't have an obligation. And here it goes back to, what is a market maker, what isn't a market maker, who's a proprietary trader. If that HFT guy is a proprietary trader, they don't care about you trying to sell stock to them. They want to get the heck out of the way. Their job, again, is to minimize risk so that they don't lose money in their proprietary account. So if they see something going wrong, boom, they hit the button. And then even worse, they will exacerbate the problem often by now going short. So there they were bidding for stock. They see something going wrong. They cancel the bids, and now they become a short seller. Do they have the borrower, which is a question that's been asked forever. Mm-hmm. Short sellers have to have a borrower or a locate, and if you're a market maker, you do have some exemptions, so some of these guys hide behind the market maker fact. But if they may not be, let's assume they have the borrower, which I doubt many of them do, now they'll become a short seller and start demanding liquidity from the bid side. So guess what? Now you're in a cycle. So all of a sudden, and this happens within milliseconds or microseconds. So what we see as a second is almost no time at all. What they see as a second is an enormous amount of time where enormous amounts of quotes go back and forth. So they're out there starting to bang on the bids, saying, "Oh, I can bang out that bid before this thing plunges." Now the next thing you know, the stock's down, 5%, and they got the heck out of the way and sold some short in the meantime, making it worse rather than trying to help cushion or, back in the day, market makers were known as shock absorbers, right? They would try to supply capital to cushion these types of blows because they also had customer order flow. Now, proprietary traders have no customer order flow, could care less about what goes on in the market. They just want to make money. So do you think they care if the stock drops 10% and they don't have a position? They could care less. If anything, they'll see it as a buying opportunity down 10%. And in the meantime, they'll try to make some money. So that's how a mini flash crash starts. It's kind of a cycle. Maybe sometimes it's generated by a quick news event, and I'll go read something off of the news, and off she goes, and you've got a 10% move. Or sometimes it's driven off of a related stock. Or whatever it may be, whatever the cause is, you'll get these rapid moves, 10%. They do have now circuit breakers in the market where single stock circuit breakers will kick in at either 5 or 10% levels, and then they'll tend to stop these events. But in the meantime, the damage is done. And if you have here's the worst thing you can do. Either you have a market or a limit order in there. If you have a stop loss and it converts into a market order, so if you say, okay, well, if the stock goes down 5%, I want to automatically sell. Well, that market order will feed right into this thing. And that's what happened during the flash crash of 2010. A lot of these stop losses converted to markets, which is the worst thing you could possibly do. So put limits on either your stops or your regular orders.
With just to flesh that out one step further, because if you put a stop on there and you say, okay, 5%, that's it. But if that converts to a market order, the market's down 10%, you're going to take that, you're going to eat a 10% loss, not your 5% stop.
Right.
Yeah.
And you're going to go home and you're going to say, why is my fill at $22 and now the stock closed at $25? Well, you convert it to a market order, and it hunts it down. So a market order hunts looking for a bid at that point, and they're trying to find it, and there's nothing there because all the HFT guys and everybody disappeared. All those so-called liquidity providers and now liquidity demanders, and it's a problem. So I'm always, rule number one, never, ever. You can't put market orders in unless you're sitting there watching it every minute.
What about the flip side of that? What about putting in a stink bid that sits like 20% below an equity, thinking that maybe it might flash crash down to there and you could pick that up?
You could try. Yeah, I mean, the other guy we tend to see a lot of bids that sit right above the limit up-down level. So in other words, the circuit breaker kicks at, say, 10%. You'll see lots of buyers hanging right above that 10% level because they know exactly that. They're trying to sit down there and hope for one, and then that's fine. And then you can absolutely, however, it could be real news and you could get smoked. So you got to be careful there, too.
Well, sure. So what's been happening to market liquidity and volume over the years? Where are we relative to the past?
Volumes have been fairly consistent, if not towards the low end, compared to, let's just say, 5 years ago, or certainly a financial crash back in '08. I mean, there were huge volumes then. Volumes are I would say volatility is very muted. Obviously, you can just look at the VIX index. Volumes are not great. I think what happened is the passive worlds over the last few years have taken over. The ETFs obviously have taken over. The active money is shrinking to an extent, which is sad in a way, which is very sad because those are the real stock pickers who go out there kicking the tires of companies and finding out what's really going on, as opposed to some of the indices, which is just kind of obviously combining all those. But either way, it is what it is. That's the market. The market's you can't argue with the market. That's what people want. So volatility is lower. Liquidity, it depends. It depends on a day. If there's news and there's all of a sudden a tariff story comes out or something like that, you'll see liquidity evaporate within minutes and then come back later on. So it's still not, buffer zones out there. You still have major potentials, and I still blame a lot of the structural issues for that and that haven't been fixed.
And we saw in some of those structural issues led to flash crashes that were in really large markets. The largest there happened to be the 10-year Treasury market had a flash crash in yields, which was a panic buy. We had a flash crash in the dollar at one point. I mean, this really seems to me like something where if you say, my gosh, by the time we're having crashes in markets that large, allegedly that liquid, that really speaks to some sort of a broken system at that point in time. Is any of that awareness, coming into either that congressional testimony you gave or into the SEC at this point?
I do think they're looking. First of all, I give the SEC a lot of credit over the last year since Jay Clayton came in. They're moving much quicker, and they're doing a lot more than we saw in previous administrations of the SEC. So they are starting to see that. I mean, if you go back to the 2010 flash crash, it took them 6 months to come up with a report as to what happened, and that's still debatable as to how the flash crash happened. Mm-hmm. No one agrees as to what was going on there, and I think that basically it goes to one serious deficiency which still exists in the market. They don't have the proper surveillance. The surveillance that's out there is good for a market from 2010, but it's not even 2000. The surveillance is not good enough for 2018 when you have, high frequency traders zipping in and out in microseconds, short sales that are not have borrows. One or cross market. Basically, what happens now is it's not just the equity world, right? They're trading every asset, and any high-frequency trader worth anything is trading multiple asset classes. So they may be saying, okay, I'm going to trade stocks versus options, futures versus stocks, maybe bonds versus options, whatever it may be. There's no surveillance system currently out there that can see across different asset classes. And that's a major problem. So there could be a guy spoofing on the equity side, trying to, in other words, putting fake bids in a stock, and he's laying it off on the options market, and you can't tell right now. Okay, for FINRA, which is our self-regulatory organization, which oversees a lot of the exchanges, they have to kind of piece that together, and it's a massive job for them. It's almost like I compare it to a quilt where they're putting pieces together and they're sewing it all, and they're trying to figure out what happened. It could all be fixed, and it has been addressed, something called the Consolidated Audit Trail, where the SEC has been trying to get this thing built since the flash crash. They've been putting it out there. Unfortunately, they let the industry do it. And here's a major problem. Don't let the industry police themselves, okay? Rule number one.
Rule one.
Let the industry build, right? Rule one, put that on top of they should put that on top of the SEC charter. But the industry, the exchanges, got to build this Consolidated Audit Trail. And to make matters worse, they subbed out the build. When they went to build it, it's still in the build process, and it keeps getting delayed, by the way. They said, okay, who wants to build it? We'll put it out for, the exchanges made the spec, and they said, this is what we need. Okay, we need someone to build it. FINRA would have been a logical choice because they have the ability to do something like this and the know-how. Instead, they chose a firm called Themis Technologies, which is a small firm, and maybe I don't know most of the folks there, but Themis came out of a firm called TradeWorks, which was an HFT firm. Okay, TradeWorks had a subsidiary called Themis Technologies, and now they've created Themis Cat, which is building the cat. Now, I don't know if there's anything wrong with that or not, but I just think it's kind of odd that you would have an HFT offshoot build the Consolidated Audit Trail, which is set to kind of figure out if, say, HFT is doing some bad stuff. It's kind of weird. But it keeps getting delayed and delayed. It was supposed to be live as of November of this year. It's been delayed again. So, the industry wants to drag it out because I believe that they know there's all sorts of bad stuff out there. And the last thing they want are a bunch of eyes and ears looking at what's going on underneath the quote, if you want to call it, because that would kind of kill a lot of their business models. Stock exchanges are built on selling data. They're not built on listing IPOs anymore. How many IPOs are out there? They're not built on trades. They don't get paid really on trades. They're built on data sales and anything related to data. So if you start looking and saying, hey, your data's garbage, basically, because you got a bunch of noise in there with a bunch of guys who are spoofing and layering the market, well, maybe their business model is now being challenged, and they're afraid of that. So in our opinion, again, they're slowing this thing down. They've been slowing it down for years because they don't want anybody looking underneath.
I completely get that. And I'll tell you from my own very limited experience as somebody who was trading gold and silver futures for a while, I would never think of trading the futures without having both the related options and the underlying shares of gold mining and silver mining stocks up on my screen, because I could see that that when when a big slam was coming, it would get telegraphed early, or a big move either way would get telegraphed in those other markets. So I knew that as just a doof on the street with a fat finger pressing my buy and sell button. I knew that in 2008. So I assume this has been going on a long time.
Mm-hmm. Oh, absolutely. I mean, this is, they call it arbitrage, right? Fancy term, right? It's arbitrage. And they will say, we're helping the market because we're putting prices back in, but realistically, they're proprietary traders trying to take advantage of one market versus another. And to an extent, okay, we get it, but when the exchanges are selling them tools to make them faster and allow them to get more robust information, your information, by the way, and able to process that information just like the social media companies are doing, right? Just like taking data and parsing it and selling it. That's what stock exchanges do. They take your data, you give it up the rights. When you sign on to become a broker, if you're a broker on an exchange, you give up the rights to the data, basically. They can do anything they want with it, and they figured out a way to monetize it. And they monetize it a lot, and they're making a ton of money off of it. And there's two sources of revenue, by the way, for exchanges when it comes to data. There's the SIP revenue, which is the Security Information Processor, that basically it could be $400 to $500 million a year that they just divide up. And those are fees that regular retail investors pay, that I pay. And then there's the much more robust proprietary data feeds that they sell for thousands and thousands of dollars per month per subscriber, and they're making a lot of money on the data. So, it's the data, stupid, right?
Right.
To coin a phrase.
and they make money at it because the data is worth a lot of money to somebody else who's buying it, obviously. So when we look at that, let me. So what I really want to get at here, ultimately, Joe, is this idea of market structure. And so let me just take the other side of this, and I'm going to quote now from the second paragraph you have here in your written testimony before the U.S. House of Representatives Committee on Financial Services, and you wrote here, quote, "We've been in a bull market for many years, and volatility is at record lows. Often in such times when everyone is pleased, when they open their brokerage statements, it becomes easy for our industry and regulators to become complacent and not to ask tough questions that should always be asked." Getting to the market structure, end quote, to this market structure at this point, what questions really ought to be asked here, particularly by people who are pleased with their brokerage statements?
Okay, I think it's a great question, and we will talk about one issue till keep beating it down. It's called payment for order flow. Right, payment for order flow, which was really kind of I don't want to say glamorized or advanced in the industry way back by Bernie Madoff when he had Madoff Securities, where they were a third market maker, and they would buy flow to try to trade it off exchange. They would buy retail flow, essentially. Payment for order flow is everywhere in the stock market today. It's at the exchanges. It's by them paying rebates to attract liquidity and access fees. It's at the market makers trying to buy your retail flow. And a lot of people are talking lately about this firm called Robinhood, which gives out zero. It's a zero to trade. It's free. Well, why? Everybody knows there's nothing for free in this world. The way Robinhood makes money apparently is not only margin, but they're also selling their order flow to these various market makers. So they have a nice revenue source. And the question becomes, what's going on with your order? That's what you need to be concerned about. But as a retail investor, you should know, what happens when you hit that button. Right? You need to know the mechanics of the market. You need to understand underneath, people think we're kind of dorks and geeks because we study this stuff so much. But if I don't know how to operate an engine, if I'm a race car driver and I don't know how the engine works, well, I shouldn't be behind the wheel of that car. I need to know the engine, and one of the most biggest parts of that engine is this payment for order flow and how it's corrupting broker order routing processes. Has been going on for a long time, and basically distorting how trade should be happening. So the SEC saw this, and I'm very happy about this actually, because about a year ago they had their own advisory committee that they formed, and they recommended what they call a transaction fee pilot. In other words, a pilot program, and the SEC actually just proposed it last month, where they will start to eliminate rebates or eliminate some of the payment for order flow that's going on the exchanges, which is a fantastic way to address the issue, which is at a core problem here. So the proposal is out there right now. Well, there's been a ton of comment letters, as you can imagine, because this is a big thing for the industry. Lots of people are in favor of it. Most institutional investors that we deal with are in favor of it. Most exchanges, as you'd imagine, are against it because this goes to the heart of that data that we were talking about. We're hoping that the SEC finalizes the proposal soon and this goes out, and then you can study. And then you can look at the data that you're getting from the fee pilot saying, hey, we did have a problem with order routing. Brokers were taking advantage of retail flow by selling it to market makers. That's not a good thing. Although this program, I must caveat that, won't cover the payment for order flow off exchange. It only covers the payment for order flow on exchanges. I know it gets confusing, but I hope what will happen is once they do this one, then they'll extend it out to off exchange trading as well.
So let's look at this now with the idea of you mentioned passive versus active investing. Obviously, a huge sort of structural shift in that, where people and investors wandering away from active into passive, and a lot of that passive comes through exchange traded funds or ETFs. Talk to us about the those ETFs and that their relationship to this overall structure you're talking about. One, we have this ecosystem of these, Wild West sort of taming down as they fight each other to a standstill. OK Corral over here happening with all the financial and electronic shenanigans over there. Okay, great. We got the computer world, and on the other side we have now most of the market really trading through these passive funds. We put those two together. Are there any risks here we need to be aware of?
Well, I think there are risks in some of the more esoteric ones, shall we call them. Mm-hmm. Things like the double and triple leveraged volatility products. Okay, that was a huge problem recently, and people didn't know what they were buying, right? So do I have a problem with an ETF that is, that represents the NASDAQ 100 and that holds those securities? Absolutely not, because that's a vehicle that actually diversifies risk. That's a good idea for a lot of investors who don't want to find particular names and they're not sure which part of the industry they want to buy. So buy that. Do you want to buy a financial sector and you're not sure which bank to go? Buy the ETF. As long as it's holding the securities and it's a legitimate company, I think it's a great idea, the way to diversify risk and not have to do that much of a kicking the tires if you don't have that time. But when there are issues, and an ETF, or they even call them ETPs, exchange-traded products, because those are the ones that may have underneath not necessarily the core holding the stock. They may have derivatives based to a certain that drive off of an index. They may have a swap in there. They may have a counterparty risk in there. There's a lot of stuff that goes on in those doubles and triples and volatility ones that you really need to read the prospectus. You really need to, and I think that anybody who trades those, we lobbied for a while, brokerages should make them sign a form similar to an options disclosure requirement, which says that you understand how to trade options. You should really understand those volatility products and those leverage ones, because they're dangerous. I mean, look at that one, the VXX. It keeps going to zero. They reverse split it. It goes back to 25. It goes to zero. It's stupid. Right? It's just an absolute how they're allowed to list in the first place. It makes me wonder, where is the SEC on this? Those are gambling instruments. They're not meant to be traded. They're intraday trades, if you want to call it that, but they're certainly not meant to be held overnight. So bottom line is, know what you're buying. Know what's inside the ETF or ETP, and if you're comfortable with it, well, they definitely serve the right purpose. I mean, if it fits your risk parameters, then that's great. And I would never argue against where the market wants to go, and the market is saying, hey, we want passive products, so be it. Well,
it's certainly something that I think we sort of absolutely had a lesson on around that VXX piece a while back. The counter argument here that I'm sort of trying to build in is this idea. Look, there's been a bull market. Volatility's been really low. People's portfolios have gone up. Isn't that, some people might say, well, then the market's working great. Nothing really needs to be addressed here. On the other side of this, we might say, but we have these things called flash crashes, and we have concerns about liquidity, and we know that the central banks have been just throwing massive amounts of cash into these markets for a long time. They're starting to slow that down a little bit. The question would be, what could happen at a time if we ever did get back to, or in many cases where you have increasing voices out there saying there will be another moment where there is a financial panic or a global liquidity drying up event. Isn't there my concern is, won't these markets be tested in a way they haven't been tested? And isn't the concern that they might just, if you have enough algorithms say I'm not participating, we don't have market makers anymore. What happens, do you think, in that moment if that sort of dystopian future comes? Markets dry up. There's no market makers. You have all these algos that are so far out of parameter nobody can turn them back on again. What happens then?
Yeah, you got a major problem, and you're right. It hasn't gone away. Right, and that's why our point was, when in times like this, when there is no storm out there, It's time to fix the house now to make sure that when the storm comes, the house doesn't get knocked down, right?
Mm-hmm.
So I think that's exactly what you're saying. So how do you fix the house? By doing some of the things like we're talking about when it comes structurally, getting rid of some of the conflicts of interest, maybe adding more obligations for market makers, looking at those off-exchange venues, which are considered, dark pools and what's going on there, looking at all different types of the issues that continue to haunt us, but they don't pop up until the end. And can you force a market maker to stand there and buy stock when the stock market's coming down? No, you can't force them to do that. And that's the way it is. So you can't, going back to liquidity, you can't assume that there's going to be liquidity today at this minute because there was liquidity yesterday. It doesn't make any sense. The market makers will disappear. So is there natural liquidity? Mm-hmm. And that's really the issue. And natural liquidity are real buyers and sellers, institutions and retail. And unfortunately, natural liquidity is still much, much smaller in the market than, let's just say, artificial liquidity, if you want to call it that. So I still think you fix the structural issues, you'll have a better chance. But will you prevent another flash crash? No. Will you prevent another problem when all of a sudden everybody hits? There was a famous thing back in the 2010 crash, and they quoted one HFT as saying, "Oh, I saw it coming. I saw that it was happening, and I went to my keyboard and I typed the letters HFT stop, and I hit enter, and that basically took me out of every market." So basically, he had a ripcord. He pulled the ripcord, and it took him out because he didn't know where the risk was. He didn't know what markets were doing what, and he wanted no part of it. So what happens if everybody types in HFT stop at the same time? You got a major vacuum in liquidity again. You can't prevent it. You can't. It is what it is there, and you can deal with some structural issues to try to encourage more liquidity, but you cannot prevent that. And yeah, when things get hairy, I would expect markets to start choppy around. But like you said before, fortunate, we're in a market now which is different. It's based on fundamentals. We've got some good earnings out there. Companies are still strong. GDP is growing. There's a lot of good things in this market right now. People are buying those dips, right, because they see the dips as opportunities. That's a fundamental analysis that, I tend to agree with it at this point, but it doesn't mean that in a year from now, it's not going to get really choppy out there.
Great. So let's, Joe, in the time we have left, let's turn now to cryptocurrencies. I know a lot of people who've been in them, and I think there was a really exciting story and case to be made for how these were going to be very transformative. But over the last several months, particularly after I looked at what was happening with Bitfinex and some of the exchanges and this whole idea of the tether and not really trusting the audit scale and having read some great works by Ben Hunt of Sally and Partners at the time, we're talking about how this is a market that's highly unregulated. And over the last few months, watching the entire universe of the top coins basically move in lockstep now, I couldn't come to any other conclusion other than the computers now have these markets by the short ones. What are you seeing there?
Yeah, first, I'm a big fan of Ben as well. He does some great work. The crypto market, in my opinion, I don't trade cryptos, but I see a lot of similarities to what we saw years ago in the equity market. But the problem for crypto, and I don't have an axe to grind either way. If you want to buy Bitcoin, you want to buy Tether or Ethereum, whatever it may be, I really don't care. That's their people's business. But when you try to get into the markets with ETFs and futures and options, well, that's where I tend to raise my eyebrows and say, wait a second, you have an unregulated product that trades across all different exchanges around the world that no one is looking at. Okay, there's no cross-asset, cross-market surveillance of these exchanges. Somebody could be spoofing in one market and laying it off in the other, just like we were talking about before in the equity market with the Consolidated Audit Trail. But there's nobody looking. Okay, and I think for crypto to be serious, for them to grow up, and for anyone to take crypto seriously, they need, unfortunately, I hate to say it for them, they need regulation. They need an adult in the room to take a look and say, wait a second, we're watching, there is money behind, Tether, there is something here, they have been audited, the exchanges have been audited while looking for spoofing and layering, so therefore, we're okay with the futures market at that point. But right now, no one's doing that, and the firm recently, Gemini, came out and said that they recognize this. Okay, those guys are pretty smart, the brothers, right? And they created something called a virtual, I think it's Commodity Association. They're trying to create a FINRA for crypto, which I think is a wonderful idea because you need an oversight. But their problem is they've got about 3 or 4 exchanges underneath their oversight. What about the other 100 that are trading these or wherever they may be? What jurisdiction watches them? Who's watching, Bitcoin in Hong Kong? It's very tough to do. So, I think that this market is just filled with fraud, filled with manipulation, filled with all sorts of abuses. And until you can somehow figure out a way to regulate it, no way, and I'm very strong on this opinion, no way should any crypto ETF be formed or approved by any regulator in the U.S. Because I know they tend to exist. There's a couple, I think one in Sweden. But how are you going to create a derivative based on a cryptocurrency which is unregulated? It's a time bomb. Okay, it is a time bomb that will then seep into what's going to happen if they ever created it and pushed it out there. You can bet Aunt Ethel out in Kansas City is going to have a broker, and that broker is going to say, hey, guess what? You want to get a little extra return in your portfolio? Let's put this ETF Bitcoin in there. It's been approved by the regulators. It's safe, but it's not. Okay, because we know what's going on in the underlying markets, and then before you know it, people who should not have exposure to the crypto market's going to be exposed. So you're looking at major problems if they ever approve that without regulation. Now, if they somehow figured out a way to regulate and monitor and surveil the underlying markets, then I don't have a problem with it. Then go ahead. It's a derivative of, hey, we have derivatives on gold, we have derivatives on agricultural products, so be it. Right? But they don't have the regulation right now, so you can't go there. But now the industry, by the way, who's pushing this? It is the same players from the high-frequency trading industry, the exchanges, the market makers, the same people who pushed their way through the equity market back in '08 and 10, who were having a field day because it was easy to trade back then, are now trying to get into the crypto space, and they know they need to link various products so they can have an arbitrage opportunity. So they're the ones pushing the ETF. The NYSE Arca and BATS, or SIBO, are the ones pushing the ETF. They keep filing, and the SEC keeps rejecting it. And the SEC they're very strong. They say, until you get a cross-asset surveillance, cross-market surveillance, don't come back. What do? They come back again with the same stupid proposal. So those guys are pushing it because they see it as a new ground to sell data, to list products for their revenue stream, because guess what? Exchanges are public companies. They have stock prices. They have shareholders. They need to make more money. How do they make more money? They list new products. But what are they creating here? These are potential time bombs. Again, so I'm very concerned, extremely concerned about derivatives of the spot market. If you want to trade spot market and you've got a app that does it, play at your own risk, basically. But that's your own money, and it's an isolated effect, in my opinion. It wouldn't be a contagious effect. Where once this thing seeps into the regular markets, I think we have to be very careful.
It's always about the money, isn't it? I love this delicious irony that you have this highly regulated product built on top of an entirely unregulated market. It puts a level of gravitas that really doesn't belong there. But you're right, it will be used. And in Ben Hunt's terms, he talks about coyotes, which are people who are too smart for their own good, and raccoons, which are just basically thieves. A lot of raccoons out in this space of the crypto space. Why? Because there's a lot of money to be made there. And if there's money to be made there and it's unregulated, you can get away with it. Trust me, you got raccoons all over this thing. Trash pandas everywhere. It's an astonishing thing. So as we look at that, Joe, hey, first, thank you so much for your time today. It's just, again, just such a fount of knowledge, and I've learned a lot myself. I know my listeners will as well. How can people follow your words and your wisdom offline from this?
Yeah, sure. We still maintain a blog. We'll post maybe once or twice a week. ThemisTrading.com. I'm on Twitter, Joe Saluzzi. We tend to tweet a lot. My partner Sal, Themis Sal, he's on Twitter as well. And we only pretty much tweet on market structure issues, and we tend to be critical, and that's just who we are. We tend to be, some people call us cynics or critics or whatever. I like to look underneath the hood to see what's going on. So we use those social media platforms certainly as a way of kind of getting out our message and talking to everybody, and we like to interact with people on Twitter as well.
All right. Well, thank you so much for doing that. I really appreciate it personally. And we do need people who are critics and looking under the hood, because otherwise it's it's you get what we had for a while there. And so it does feel like we're going ahead in the right direction. So thank you for your time today and your efforts in getting us pointed in that new direction.
You got it, Chris. Thank you. And maybe we'll talk in a couple of years and everything will be great again, right?
Absolutely. All right. Thanks, Joe.
Thanks, Chris.